Hello everyone, welcome to the 81st episode of me learning how to trade in Forex. So in the last episode we went through the types of breakouts that we can get. So we got the continuation breakouts, reversal breakouts, continuation breakouts being, so we've got the initial downtrend or uptrend, whatever it is, and then we got a period of consolidation, and then the continuation breakouts. Is as the name suggests, so after the consolidation bit, it continues from the initial trend, whichever it is. So in this case, the initial trend is a downtrend. After the consolidation, then it becomes the downtrend again because it continues from that downtrend. Reversal is the opposite of the continuation, so whatever the trend after the consolidation area is going to be the opposite of the initial one. So in this case, the initial one is going to be a downtrend. We've got the area of consolidation, and then after consolidation we've got the uptrend. And then we also learned about the false breakouts, so what they are, how to trade, how to enter on a breakout, wait until the price retraces back to the original breakout level, and then wait to see if it bounces back to create a new high or low. And then also is not taking the first breakout you see. Wait until the price will continue to move in the intended direction, and then take the trading opportunity then. So in this video we're going to go through how to trade breakouts using trend lines, channels and triangles. So how to trade breakouts using trend lines, channels and triangles. Date is the 21st. Just like breakouts on your face, the nice thing about breakout trading in Forex is that opportunities are pretty easy to spot with the naked eye. Unlike the former, you don't even have to look in the mirror. Once you start getting used to the signs of breakouts, you'll be able to spot good potential trades fairly quickly. So, chart patterns. By now you should be accustomed to looking at charts and recognizing familiar chart patterns that indicate a reversal breakout. Here are just a few: double top bottom, head and shoulders, triple top bottom. For more information, check out our lessons on chart patterns. In addition to chart patterns, there are several tools and indicators you can use to supplement your case for a reversal breakout. So, breakouts can be spotted via chart patterns, trend lines. So these are double top slash bottom, head and shoulders, triple top slash bottom. Trend lines. The first way to spot a possible breakout is to draw trend lines on a chart. To draw a trend line, simply look at a chart and draw a line that goes with the current trend. So we've got the downtrend here, so a falling trend line. When drawing trend lines, it is best if you connect at least two tops or bottoms together. Connect at least two tops or bottoms together. So when drawing trend lines, it's best to connect at least two tops or bottoms together. The more tops or bottoms that are connected, the stronger the trend line. The more tops or bottoms are connected, the stronger the trend line. So how can you use trend lines to your advantage? When the price approaches your trend line, only two things can happen. The price should bounce off the trend line, continue the trend, the price could break through the trend line and cause a reversal. We want to take advantage of that breakout. the price could bounce off the trend line and continue the trend. Also, in this case here, it bounces off here and continues the downtrend. Price could break through the trend line. We want to take advantage of that breakout. Looking at the price is not enough, however. This is where using one or more of the indicators mentioned earlier in this lesson could help you tremendously. So we've got a rising trend line signaling an uptrend, and then we got here, it breaks through the trend line here, and this is a breakout here, and it turns into a downtrend. Notice that as Euro USD broke the trend line, moving average convergence divergence was showing bearish momentum. So we've got the moving average convergence divergence here. As it broke the trend line here, strong bearish momentum. Why does it show strong bearish momentum again? So moving average MACD. Where is this? Moving average. Alright, here we go. So we've got the zero line over here in the middle. Strong bearish momentum. If the MACD crosses below a zero line, it may signal a bear run. So over here, so we've got the zero line and then it crosses below the zero, so signaling a strong bearish momentum. Okay, cool. Using this information, we can safely say that a breakout will continue to push the euro down, and as traders, we should short this pair. When price approaches the trend line, two things could happen. Price bounces off the trend line and continue the trend, or price breaks through the trend line and cause a reversal. We want to take advantage of that breakout. Use other indicators along with the trend line for extra confirmation. Channels. Another way to spot breakout opportunities is to draw trend channels. Drawing trend channels are almost the same as drawing trend lines, except that after you draw a trend line you have to add the other side. So we've got channels basically enclosing the trend, so we've got the ups, the tops, the highs and the lows. So rising channel because the channel's going upwards. Channels are useful because you can spot breakouts in either direction of the trend. So either through this side or through this side. The approach is similar to how we approach trend lines in that we wait for the price to reach one of the channel lines and look for the indicators to help us make our decision. So we've got the same one over here. It breaks through the bottom or the lower channel, I think that's called. So it's currently in an uptrend, but then as soon as it broke through, it went through a downtrend. And to confirm that it's actually going to go down, we can see we've got the moving average convergence divergence here. So it's always been above zero here, which means it's a bullish trend. And then if it goes below zero, if it crosses zero line into below zero, then it's starting to show bearish momentum, which is exactly what it shows here. So the price is going downwards. The approach is similar to how we wait for the... Notice that the MACD was showing strong bearish momentum as Euro USD broke below the lower line of the trend channel. This would have been a good sign to go short. Channels in either direction. The trend. Triangles. The third way you can spot breakout opportunities is by looking for triangles. Triangles are formed when the market price starts off volatile and begins to consolidate into a tight range. So formed when the market price starts off being volatile and begins to consolidate into a tight range. Our goal is to position ourselves when the market consolidates so that we can capture a move when a breakout occurs. There are three types of triangles: ascending, descending, and symmetrical. Three types of triangles: ascending, descending, and rectangle, symmetrical. Well, I should probably do pictures. Trend lines. Actually, we'll do pictures at the end. So ascending triangles. Ascending triangles form when there is a resistance level and the market price continues to make higher lows. Wait, so let me just do this first. Trend lines. Channels. Da, 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 da. Triangles. Or A is ascending triangles. Ascending triangles. Ascending triangles form when there is a resistance level and the market price continues to make higher lows. This is a sign that the bulls are slowly starting to gain momentum over the bears. So the story behind an ascending triangle is that each time the price reaches a certain high, there are several traders who are convinced about selling at that level, resulting in the price dropping back down. On the other side, there are several traders who believe the price should be higher, and as the price begins to drop, buy higher than its previous low. The result is a struggle between the bulls and bears, which ultimately converges into the ultimate showdown. Forms, ascending triangles. Form when there is a resistance level and the market price continues to make higher lows. This is a sign that the bulls are slowly starting to gain momentum over the bears. A sign that the bulls are slowly starting to gain momentum over the bears. So we've got the resistance here, higher lows, ascending triangle. Because the lows are getting higher, so it's called higher lows. Wait, that pattern over here, that looks similar, doesn't it? The ABCD pattern, I think that's called. Not as triangles, not as AB. There we go. Where is this? Not Haken. The 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And then it's the ABC after it. It's an A. 1, 2, 3. 1, 2, 3, 4, 5. A. So A goes down. B goes up again. And then C drops back down again. C drops back down again. Oh. I don't know if that's even like right. But anyways, that went off track. Ascending triangles, this is a sign the bulls get low momentum. The story behind an ascending triangle is that each time the price reaches a certain high, there are several traders who are convinced about selling at that level, resulting in the price dropping back down. So, each time the price reaches a certain high, there are several traders who are convinced about selling at that level. Resulting in the price dropping back down. On the other side, there are several traders who believe the price should be higher, and as the price begins to drop, buy higher than its previous low. The side, there are several traders who believe the price should be higher, and as the price begins to drop, buy higher than its previous low, which converges to the ultimate showdown. What we're looking for is a breakout to the upside since ascending triangles are generally bullish signals. When we see a breach of the resistance level, the proper decision would be to go long. What we're looking for is a breakout to the upside, since ascending triangles are generally bullish signals. When we see a breach of the resistance level, the proper decision would be to go long. Leading to a struggle between the bulls and the bears. So look for a breakout through the resistance line, through resistance level, since ascending triangles are generally bullish signals. Yeah, I don't really understand what this the story they created for this means. So, like, what this bit means. Each time the price reaches a certain high, so like here, so it reaches a high here, there are several traders convinced about selling it at that level, resulting in the price dropping it back down. So they think that the price won't go any higher than that one, so they're selling it. So if they're selling it, then there's more supply than demand, so the price decreases. Yes. On the other side, there are several traders who believe the price should be higher. So, and as the price begins to drop, buy higher than its previous low. So, since the price decreases here from this, from all the sellers, the buyers, so they think that the price of this should be higher, so they start buying at a low price due to the high supply that is out there. So that means the demand is shooting upwards, so the price should be increasing again as well. So then you got both the price decreasing and then the price increasing, so which is the struggle between the bulls and the bears. I think that's what it means. Okay, descending triangles. Triangles are basically the opposite of ascending triangles. Yep, sellers are continuing to put pressure on the buyers, and as a result we start to see lower highs met by a strong support level. Descending triangles are generally bearish signals. To take advantage of this, our goal is to position ourselves to go short if the price should break out below the support level. Generally bearish signals look for a breakout through the support level, since descending triangles are generally bearish signals. Okay, symmetrical triangles. third type of triangle is a symmetrical triangle. Rather than having a horizontal support or resistance level, both the bulls and the bears create higher lows and lower highs and form an apex somewhere in the middle. Unlike ascending and descending triangles, which are generally bullish and bearish signals, symmetrical triangles have no directional bias. So look for a breakout through either sides of the look for a breakout through either side of the line, since symmetrical triangles have no directional bias. You must be ready to trade a breakout on either side. Yep. Price could break out on either side, so it could go either up here or down here. In the case of the symmetrical triangle, you want to position yourself to be ready for both an upside or downside breakout. A perfect time to use a one cancels the other order. Ah. Best time to use the one cancels the other order. Don't remember what one cancels the other order is? Go review your types of orders. In this scenario, GBP/USD broke out on the upside and our long entry was triggered. So, one cancels the other. A combination of two entry and or stop loss order allows you to place two orders at the same time, but only one of the two will be executed. Okay. Very good. Breaking down the triangle breakouts. To help you memorize different types of triangle breakouts, just think of facial breakouts. Ascending triangles usually break out on the upside, so when you think of ascending triangles, think of breaking out on your foreheads. Descending triangles usually break out on the downside, so when you think of descending triangles, think of breaking out on your chin. Symmetrical triangles can break out either to the upside or downside, so when you think of symmetrical triangles, think of breaking out on both your chin and your forehead. Why do you keep staring at my pimples? Here's a quick and disgusting memory tickler. Ascending triangle equals forehead breakout, descending triangle is a chin breakout, symmetrical triangle is forehead or chin breakout. Ew. Gross, eh? But we bet you'll remember it. Very good. How to measure the strength of a breakout. As you learned earlier, when a trend moves for an extended period of time and it starts to consolidate, one or two things could happen. The price could continue in the same direction, continuation breakout, the price could reverse in the opposite direction, a reversal breakout. Wouldn't it be nice if there was a way to confirm a breakout? If only there was a way to avoid fakeouts. Well, there is a way. In fact, there are a couple ways to tell whether or not a trend seems to be nearing its demise and a reversal breakout is in order. Moving average convergence divergence. By now you should have a good foundation of the moving average convergence divergence indicator. If you don't, you might want to check out our lesson on the MACD. MACD is one of the most common indicators used by Forex traders, and for a good reason. It is simple yet dependable and can help you find momentum, and in this case the lack of momentum. MACD can be displayed in several ways, but one of the sexiest ways is to look at it as a histogram. What this histogram does is actually show the difference between the slow and the fast MACD line. When the histogram gets bigger, it means momentum is getting stronger. When the histogram gets smaller, it means momentum is getting weaker. So we've got the MACD here. When the MACD histogram is small, so when the bars are like really small, it indicates that momentum is slow, so there's not much volatility going on. When the MACD histogram is high, it indicates that momentum is high, which means lots of price volatility going on, so there's a higher chance of a trend forming. I think that's what it means. We can also see here that the zero lines here, the two lines cross above the zero line, signaling an uptrend, and which it does show in the price action. The histogram on a MACD indicator shows the difference between the slow and fast MACD line. When the histogram gets bigger, it means the momentum is getting stronger. When the histogram gets smaller, it means the momentum is getting weaker. So how can we use this when trying to spot a trend reversal? Glad you asked. Remember that trading signal we talked about earlier called divergence and how it occurs when the price and indicators move in the opposite direction? Yep. Since the MACD shows us momentum, it would make sense that momentum would increase as the market makes a trend. However, if MACD begins to decrease, even when the trend is continuing, you can deduce that momentum is decreasing and this trend could come to an end. Could be close to an end. The momentum would increase as the market makes a trend, so price moving higher, but the MACD histogram moved lower. This is further confirmed by, so if the price is going higher but the indicator is moving lower, so here higher highs and lower highs, yep. Regular bearish divergence, so normally occurs at the end of an uptrend, which it does, so there's an uptrend here, end of the uptrend, and since it's a bearish divergence, we can see a trend reversal of a downtrend happens after the end of that uptrend. Further confirmed by the fact that these two lines are going below the zero line, so signaling another bear reversal, and also the histogram flips in the opposite direction, so minus below zero instead of above zero. Yep. So weaker if MACD begins to decrease when the trend is continuing, momentum is decreasing, and this trend could be close to and end. You can see from the picture that as the price was moving higher, MACD was getting smaller. This meant that even as the price was still trending, momentum was beginning to fade out. From this information we conclude that a trend reversal was highly likely, and it does happen. The relative strength index. The relative strength index is another momentum indicator that is useful for confirming reversal breakouts. Basically, this indicator tells us the change between the higher and the lower closing prices for a given period of time. We won't go into too much detail about it, but if you would like to know more, check out our lesson on the relative strength index. RSI can be used in a similar way to MACD in that it also produces divergences. By spotting these divergences, you can find possible trend reversals. RSI can also produce divergences. So we can see that the price is making higher highs, but on the actual indicator is making lower highs. So this is in the same situation as before, which is a regular bearish divergence. So occurs at the end of an uptrend, signaling a bearish downtrend is going to take place, which it does. So it goes downwards here, and yeah, what else? Relative. So readings of 70 or higher, readings of 30 or lower, readings of 70 or higher. So this is 70 line, right? I hope it is. What else? So from here, movements, the center line below. Falling centerline crossover occurs when the relative strength index value crosses below the 50 line on the scale, moving towards 30 line. This indicates the market is decreasing in strength. It is seen as a bearish signal until the relative strength index crosses the 30 line. So here we can see from above the center line, so above 50, which is here, to below indicates a falling trend, so it does fall. So it's falling trend. Does it cross over the 50 line? Yeah, it kind of does. So it crosses about here, and when it does cross, market is decreasing in strength, seen as a bearish signal, and which it is a bearish signal because it is going in a downtrend. So wow, indicators, very good. Lower highs, trend reversal. However, RSI is also good for seeing how long a trend has been overbought, oversold. A common indication whether the market is overbought is if the RSI is above 70. So if RSI is bigger than 70, Market is overbought if RSI is less than 30, right? Below 30, yep. Market is oversold. Overbought means too many buyers, oversold means too many sellers. So if there's too many buyers, that means, and not enough sellers, then that means there's more demand than supply, so that means price is gonna increase, right? If RSI is above 70. Wait, if RSI... Oh, never mind. Readings of 70 or higher indicate overbought market conditions and an increase in possibility of price weakening. Oh, right, okay. And readings of 30 or lower indicate oversold market conditions and an increase in the possibility of price strengthening. Right, okay, so if it's 70 or higher, there's an increase in possibility of price going down. Readings of 30 or lower indicate oversold market conditions and an increase in possibility of price strengthening going up. Never mind, I was completely wrong. Okay, yep. Because trends are movements in the same direction for an extended amount of time, you'll often see RSI move into the overbought oversold territory depending on the direction of the trend. If a trend has produced oversold overbought readings for an extended period of time and begins to move back within the range of the RSI, it is a good indication that the trend may be reversing. So, if a trend has produced overbought or oversold conditions, readings for an extended period of time and begins to move back within the range of the RSI, it's a good indication that the trend may be reversing. So, overbought territory, I don't know how long it is exactly in a long period of time, but it looks like to be, so this is the June the 11th, so from about here to about June the 15th maybe, so it's about 14 days, 2 weeks, which is pretty long I guess, for a long time, and then moves back within the range of RSI, so it has moved back, so it starts to move, it went below it. It's a good indication that trend may be reversing, so it's starting to reverse, which we can see is starting to do it, and then does it. In the same example as before, the RSI showed that the market was overbought for a billion days, okay, not that long. Once RSI moved back below 70, it was a good indication that the trend was about to reverse. Indication that the trend will be reversing. Yep. I am going to leave this episode here. Yeah. I don't really know what to say, to be honest. Combine lots of indicators together. There we go. That's what I'm going to say. Because you can always use them to cross-reference with each other and just confirm with each other whether what you think could happen will actually happen, or there's going to be a higher chance of it happening, because multiple indicators actually confirm with each other and say they all have the same opinions on whether it's going to happen or not. So yeah, that's that. So in the next video we're going to carry on with the trading breakouts and fakeouts into how to detect fakeouts. So yeah, thank you all for watching this video, and I will see you all in the next one. Peace.